By 2020, how a firm deals with tax risk will be viewed as a competitive advantage or disadvantage. Investors will expect robust and efficient tax infrastructure, and they will have zero tolerance for tax uncertainty or tax adjustments. The latest PwC report, called Asset Management 2020 and Beyond, Transforming Your Business for a New Tax World, focuses on the changes ahead for the tax function. Let's look at some of the key predictions in the report and what they mean for investment firms in North America. Global tax information reporting requirements such as BEPS and similar transparency initiatives will grow exponentially and have a material impact on operations. This will mean whole-scale budget reallocation within the tax function. The tax function will be exposed directly to regulators, which demands transparency regarding global taxation and to public stakeholders. So tax transparency will become a fact of life. In particular, tax authorities will focus on the economic nexus of an asset management contract. In the U.S., for example, economic nexus taxation will grow from 8 states in 2015 to become commonplace by 2020. So, for instance, a Singapore-based asset manager servicing a U.S. pension fund could be subject to double taxation from both the local U.S. state and the Singaporean tax authority. This is despite the fact that the Singaporean manager does not have a physical presence in the U.S. Firms will respond by moving many offshore financial center products onshore into registered products in treaty jurisdictions. All this requires the tax function to communicate clearly and thoughtfully about firms' corporate contribution to the communities in which they invest and do business. Information sharing will be commonplace among taxing jurisdictions, and taxing authorities in North America will have the capability to mine data and conduct global audits, resulting in increased disputes. This means investment firms will deal with many more inquiries from authorities. The focus on reviewing data and ensuring data quality before it is made available to the authorities will become considerably more intense as compared with today. Enhanced stakeholder scrutiny and reputational risk will force firms to continuously reevaluate their tax decisions. These decisions will be routinely supported by recommendations by the tax function. Firms will place more strategic focus on jurisdictional reporting and documentation of business activities, including transfer pricing, in order to manage the increased tax exposure. Turning to data, tax functions will receive their information in a tax-ready format via dedicated tax data hubs, which may be developed internally, but across the industry, hubs are also licensed from a third-party vendor or accessed through advisors as part of co-sourcing arrangements. Then there is technology. Firms will use enterprise-wide financial systems to prepare tax calculations, such as income tax accounting and indirect taxes. This will replace spreadsheets and other traditional tax technology solutions used by some firms today. Many firms will rely on professional data analysis tools to assist in decision-making in areas such as detection of risk, opportunity identification, and projections and scenario planning, and overall business support. I have highlighted just a few of the predictions and ideas in the report. For the full version, please log on to PwC.com or contact me or your usual PwC contact to obtain a hard copy version. We are available to discuss the report and its implications for your firm at your convenience. Thank you for watching.